Remember my tricolor warning that I said the subprime crisis was just beginning and was soon going to spread all across the economy? Well, now it is. CarMax is crashing as auto sales tank, truck sales are crashing, and we just found out that an auto parts supplier is declaring bankruptcy. And all this is doing is proving that a weak jobs market, rising inflation, and too much consumer debt is killing the economy. My friends, the risk we have right now is the subprime crisis is just beginning and it's spreading fast. Let's take a look because CarMax stock has now plummeted 20%. It's already down now over 40% this year as the CEO cites a challenging quarter. Let's take a look because the company's overall vehicle sales fell 4.1% compared with the same period a year earlier, assisting in a roughly 28% decline in net income. And I've been talking about for a while that where retail sales go, profits will follow. Let's take a look at this chart of real retail sales against corporate profits after tax, and you can see the great relationship where retail sales go in blue, while corporate profits follow with a lag. And sure enough, that's the risk we're facing right now, is that retail sales are going to roll over and they're going to drag profits right down with it. And keep in mind, where profits go, hours worked and jobs are going to follow. And then what we're seeing then is companies are going to move into survival mode. Let's take a look at what CEO Bill Nash had to say as he cited changing market conditions, a pull ahead in sales earlier in the year due to tariff-feared buying and depreciation in its inventory fleet as some of the reasons for the company's lackluster performance. So he's saying changing market conditions, meaning consumers aren't buying cars and can't afford them, that the value of his cars and his inventory are dropping. This is exactly what we see in China's real estate market. When demand goes, prices come down. And then he's talking about all of the pull forward in demand. And that is the key point here, because we've been talking about the fact that if you pull forward enough demand from whether it's stimulus or subsidized low interest rates or any form, that the risk you face is if you pull too much of it forward, that you're going to hit an air pocket in the economy. Next thing you know, the delinquency rate starts to rise, the defaults hit, and next thing you know, you find yourself right in the middle of an all-out financial crisis. And as a result, what we see from CarMax is they announced a $150 million cost-cutting plan over the next 18 months. But there's going to be some knock-on effects because as they cut back and spend less money in the economy, businesses that rely on business from CarMax, well, they're going to see a downturn. That means they're going to be forced to cut hours. They're going to be forced to cut jobs. And you can just see the delinquency rate is going to rise. Now, the problem is right now, auto delinquencies are at 5%, repossessions at 20% year over year, as according to Ally Financial. And I said there would be spillover effects, and we're already seeing it now in the trucking industry. Let's take a look because it was now the weakest since the pandemic as U.S. heavy truck sales collapsed to levels rarely see outside a recession, which is just an indication that we probably already are in the beginning stages of recession. And we can go all the way back to April. What did we see? Data that suggested the economy was rolling back over and heading down. Let's take a look at this chart of the 3-month rolling average of heavy truck sales, and you can see it is plunging, and when that happens, it's very consistent with what comes next, and that's one of those gray shaded bars that indicates a recession. The risks now are high, and you can see again in real time that so much demand was pulled forward because of all this post-pandemic surge in production. It needed new trucks, and people went out and bottom. And guess what? Now as imports come down, people don't need trucks. And what's going to happen to those that are building them? Well, it means if demand there's dropping, and so too will employees. Now, since May of 2023, sales have plunged 131,000 or 24%, marking 4 straight months of decline. Now look at the timing of this, because what did we see in April? The economy rolled over, and look what happened in May. Sales started to come down. So this is very clear evidence that the economy is slowing and heading right into that payback period. And this is, again, a major risk, because all of a sudden what you're finding out is a lot of these companies just don't have the cash to power through this and to hang on. What it means is they're going to be forced to lay off. Freight volumes have weakened as consumers cut back, leaving fewer goods to move. Consumers still aren't feeling a lot of this, as from Kenny V Heath, the president of Ag Research, he notes that goods cost 5% more, which means we're getting 5% less stuff. And that stuff is what trucks haul. And when trucks aren't hauling, they're not getting worn out. When they're not getting worn out, people don't need to buy new ones. Now, I want to give you an update on a recent trade on DAPP, and I want you to see just how easy it is to make money in the markets using our system, because our subscribers got stopped out yesterday for a 21.12% gain. And again, a lot of people require you to sit in front of a computer and trade, but we give you risk control levels and we update them along the way, making this so easy for you to make money trading. And it's going to get even easier because we just rolled out yesterday our enhanced meta strategy. And again, my friends, we're changing the game when it comes to the way people trade. Stay tuned to the end of the show for more information, or to sign up now, grab those links in the description below. Be sure to use a coupon code for your free 30-day trial. Let's take a look at this chart of total Class 8A North American net orders, and you can see very clearly that things are weakening and rolling over. Again, that's that April effect that's rolling into May that we can see in the data now, and it's pretty ugly, because what we can note here is that final North American Class 8 net orders came in at 12,844 units in August. Get this, my friends, down 21% from a year earlier. So again, you can see this just backfeeding all the way up through the economy. Well, what's going to happen is the manufacturers are going to pull back on their production. And as they do, well, that means hours go, and then jobs. Let's take a look at this chart of durable goods new orders versus average weekly hours of production and non-supervisory employees. And you can see the very clear relationship. As new orders in blue drop, what happens? Weekly hours go right along with it. And this is something we can now start to look back to a previous show where we talked about how surveys about holiday spending were coming down. And now you can see why. People are going to work and they're seeing, look, there isn't enough new orders here, and I already know my hours are going to get cut. And that's going to be the best case scenario, because the worst case is they're just not going to have a job. And then we can turn to First Brands, whose loans drop after finance unit files bankruptcy. And now this is a company that sells parts like windshield wipers, water pumps, and filters. They've got reportedly about $6 billion in debt. But this is just the beginning. Let's take a look, because investors have been increasingly concerned about the company's extensive use of off-balance sheet financing, which allowed it to cash in early on its receivables or pay suppliers with borrowed money. Now, if you're not familiar with off-balance sheet, well, let me give you some perspective on this. So let's say that they built a whole bunch of windshield wipers and they shipped them out and they haven't sold, and they need money to keep the business running. So they go to an off-balance sheet lender and they borrow against that. And of course, that's the risk, is if they don't sell, next thing you know, that off-balance sheet lender, well, they're going to go into default, because of course that loan is going to be immediately delinquent. Again, you can see the risk here is too much production. It's backing up all across the supply chain as consumers cut back on their spending. Well, nothing gets moved. And next thing you know, these companies are forced to do this, because it's either, look, they go out of business or they borrow against anything and everything they can get. But again, the problem is, if this inventory doesn't move, you can see it's not just going to affect the banking industry, it's going to affect the non-banking industry that lends against this stuff. My friends, this is about the clearest signs of a budding financial crisis that you can get. Now, First Brands has about $800 million in available cash at the end of the second quarter, and I love this term, but liquidity will be drying up fast amid the crisis, this according to Moody's rating. Now, if you're wondering what they mean by liquidity and drying up, liquidity is just money on hand. So what Moody's is saying is, look, they have $800 million, but they've got bills, they've got expenses, they've got loans to pay, they've got payrolls to make, and if things don't turn around and all this inventory doesn't start moving, what's going to happen is that $800 million is just going to continue to drop until it's gone. Company will then, of course, be out of business. And that's the risk the global economy is facing. That's the risk the U.S. economy is facing, and a lot of small businesses right now. And that's why you see President Trump has now imposed tariffs on heavy trucks and kitchen cabinets. He said today, quote, "In order to protect our great heavy truck manufacturers from unfair outside competition, I'll be posing as of October 1st a 25% tariff on all heavy, that's big trucks made in other parts of the world." And I want you to think about the timing of this. We're already seeing the data suggest that truck sales are collapsing into what is likely a recession. So if you think about it, is the issue that we're facing here the fact that we've been dealing with too many imports? No, the issue is demand is coming down because imports are going down. And Trump's planned tariffs on imported heavy trucks are, quote, a huge win for the American worker and great U.S. manufacturers such as Peterbilt, Kenworth, Daimler Truck, and Volvo's group Mack Trucks. And this was from Nick Icovella with the Coalition of a Prosperous America. He said this action will strengthen this vital sector and protect it from unfair competition. But Nick, if CarMax can't sell cars and truck manufacturers can't sell trucks, then tariffs aren't going to save anything any more than rate cuts will. Because right now the issue is that companies do not have the cash or available credit lines to survive a prolonged air pocket in the economy. They just don't have it. And we're now starting to see signs that consumers are cutting back spending in a meaningful way. And for many companies, this couldn't come at a worse time. They've got way too much inventory and they've got way too much production in the pipeline. And due to all this debt on and off balance sheet, a slowing economy and the real risk of rising delinquencies and student loans and fewer hours is just going to backfeed all across the economy. So when you see, my friends, it's very clear that when CarMax can't sell cars, that we're on the cusp of a massive financial crisis. But even in the midst of a financial crisis, there's opportunities in the market. Let's take a look at our meta strategy here. I want you to see these back-tested results and why an optimized strategy is far better than anything else on the market. Let's take a look, because when you look back over the last 2 years, this is a test on SPY. What you see, total return 71%, beating a buy and hold strategy, a win rate of an impressive 66%, generating 69 trades, max drawdown right around 7.5%. Now I want to show you this compared to an unoptimized strategy. This one run by my buddy Jay Bravo. He calls it the Bravo 9. The problem is the Bravo 9 needs a lot of Bravo help because you need a lot of other things to make this work. But as you can clearly see, total return 51%, missing buy and hold, win rate nowhere close, and half the number of trades. And look at the drawdown, about the same. So look, you're paying money to get a strategy that doesn't work and requires a lot of other tools to make it work. Now, why is our meta strategy so much better? Well, now it is not just the meta strategy, it's the enhanced meta strategy, combining 9 trading strategies into a single intelligent signal generator and fully optimized for 10-day trading. Generate, as you can see, a success rate of over 60% with fast profit taking. Now, how do you get these trades? Well, you gotta sign up for one of my reports. Now, if you want to trade against machine positioning, well, we do that in our CTA Timer Pro report, where we look to see when machines are going to be big buyers and we position our subscribers ahead of that. But maybe you like to trade those technical signals and momentum indicators. Well, we pair that with a trend and call that Momentum Timer Pro. Now, here's the great part. You get the daily report from whichever report you sign up for. You get all the signals from it, plus the new enhanced meta strategy trades. You get my opinions on the best trades, risk control levels, a full tracking of all open trades and returns, a weekly update, and here is the best part of all. Whether you're brand new to trading or maybe you're subscribed to my buddy Jay Bravo's report, we're going to give you 30 days to try it out and compare, because once you find out how much better our trades are, there's no other report you'll need. Now, to sign up, all you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.